For the second part of this lecture, we're now looking at what are the consolidated related adjustments that we can have for a statement of cash flow question. And we said the main ones are very similar to what we've done from week 1 to 6 in semester 2. Non-controlling interests, joint ventures and associates, how to deal with the equity method investments, acquisition of a subsidiary during the year, or disposal of a sub. And in any exam question, you're going to get guaranteed one of those that you need to understand and be able to approach. A mid-year acquisition of a sub or a mid-year disposal, and what impact will that have on cash flow adjustments. So the key principles are we only want the cash flows related to the group. So for example here, when you're talking about the equity method, remember the profit shown in the P&L for an associate or JV, that's not cash flow, because that's only the amount of profit earned. The only cash flows from the equity method investments will be dividends, if the dividends were paid or not. Right? Likewise with an NCI, profit to an NCI does not mean you're paying them that amount out each year. You're only interested in the dividends paid to an NCI, not the profit earned by the NCI. So it's a bit more complex than what we're looking at in terms of a normal P&L and balance sheet. And we're essentially trying to solve and explain the movements over the period. So we'll start with the non-controlling interest then. So when you have an NCI, as we know from our basic consol knowledge, the NCI is going to have a share profit in the P&L. It's going to have an opening balance and a closing balance in the statement of financial position as well. But what we want to figure out is, was there any cash dividend paid to the NCI during the period? Because if there was, that would have been credit bank, debit the NCI. So we're interested in the credit bank because that would be a cash outflow. Right? So to figure out if there is dividends, we need to compare the opening NCI figure, which will be given in the statement of financial position, the closing NCI figure, which will also be given, and any P&L profit for the NCI. So remember, you'll be given a consolidated P&L fully completed. You'll be given 2 consolidated statement of financial positions. And if there's any difference, then you have to explain it. And the only thing that moves an NCI, if you think about it from a debit and credit perspective, is the profits they earn from the year, which will be in the P&L, or if you make a mid-year acquisition or disposal. So that's where it's important to understand, if you acquire a subsidiary during the year or dispose of a subsidiary, that will impact the NCI. And that will also help explain the movement from the opening balance to the closing balance. So I said, if you're in doubt, open up a T account. It makes it much more straightforward to understand where things are coming from, and there's less chance of you getting or making a mistake. So take a small example just to illustrate this. We're just taking a very small extract of the financial statements. You will get full financial statements as you'll see in some of the past exam questions. So here's the group profit for the year 60, of which 15 is attributable to the NCI. And you're also given in the question the opening NCI was 300, the closing NCI is 306. Now for some of you, you won't need to do a T account, you won't need to do any calculations, you'll nearly be able to do it in your head. But when you get to an exam level, it's important to show your workings as well. So what we're saying is the opening position in 2014, which would be the closing position in 2013, is 300. We're not told of any acquisition or disposal of an NCI during the year, so we assume nothing happened. So that means the only thing that should have increased the NCI during the year is their share of profits. So at the end of the year, they should have been 315, 300 plus your share of profits, but they're actually only 306. So see the way we're trying to solve a puzzle? Well, if they should have been 315, now they're only 306, there was 9 of a decrease there. And the only thing that decreases an NCI, and it's not a disposal, must be dividends. So you can see in the next slide, they'll show you how you do it in a columnar format, or if you want to do the T accounts, here, you know the opening balance on the credit side, the balance brought down on the debit side, because that's a credit going forward, is 306. You have your profit, so all those 3 figures are given. So to balance it up is 315 both sides. It must have been debit NCI 9, credit bank 9. And that's a cash flow figure. So that would be a cash outflow in financing activities. So they're not overly difficult, it's just about practice. The more questions you go through here, it's a very similar logic. The only added complexity you might have here now is where you have an acquisition or disposal during the year. And that will help explain the movement from the opening balance to the closing balance. And you'll see those from question 6 onwards, where we get to more exam level questions. Question 3, 4 and 5 are quite basic ones, and we'll go through some of them in a second as part of this lecture. So that's the point I'm making at the end then. Just watch, if there was an acquisition or disposal of a subsidiary and there was an NCI involved, that would help explain the movement. So you'd have to put in there disposal to help explain some of the movement, or an acquisition if it was a major acquisition. So just keep an eye on that. Have a look at question 5 when you get a chance, and then move on to 6, 7, 8 and 9, which are more exam standard questions. But to do an NCI from the cash flow perspective, you need to know how to do an NCI from the normal consolidated perspective. So they all link together. The next one you're looking at then is your investment associate in joint ventures, which we know is the equity method, IAS 28. So remember, we're not interested in their share of profits. We're only interested in the cash flows. And there's only really 2 things that happen for cash flows for the equity method. You're either getting dividends, or 3 things should I say. You're getting dividends from the investment, you're buying a new JV or associate, or you're selling a JV or an associate. So they're the only 3 cash flow things that can happen during the year. So just keep an eye out. Am I buying a new share, which would be a cash outflow? Am I getting dividends in from an associate or JV, which would be a cash inflow? Or am I selling my associate or JV, which would be a cash inflow as well? So it's just trying to think about these things that you know already. You know how the equity method works. You know what a statement of cash flow, individual statement of cash flow works. So it's just applying your knowledge in a slightly different way. So the share profit does not involve cash flow. That means it's a non-cash adjustment. So be careful of that. When you're working, if you're doing the indirect method of cash, of getting operating cash flows, that you will be taking off the share of profit, because that is an income that's non-cash. It's an accounting adjustment. It's a credit to the P&L, but you're not interested in the share of profit of associate. You're only interested in the dividends received from the associate. So that's where the fundamental difference between the P&L and the statement of cash flows is. So to calculate the dividend received, which is always the plug figure, so every item is all, you're looking for the plug figure which goes to cash flows. You will be comparing the opening balance to the closing balance and see can you explain it. Exact same as what we've just done with the dividend. The NCI dividend, should I say, except you need to know your debits and credits. So for example, the T account for the associate would have an opening balance in the debit, which you will be given in the statement of financial position. The profit for the year, which will be given in the P&L. If you had an acquisition during the year or disposal during the year, that's where they would be slotted in. So you would have all of those given. You would have the closing balance given. Now remember how a T account works. You might be going back to first year undergrad. Your opening balance is balance brought down. This would be balance carried down. It essentially means your debits are bigger than your credits, and that will be brought down here to the opening balance next year. So if you are going to use T accounts, make sure you remember and you're not too rusty around how they operate. And your balancing figure then is your dividend received. Debit bank, money coming in, cash inflow, credit the investment associate. Remember, that's how you deal with a dividend in the equity method. You always credit the investment in the associate or the investment in the JV. So I'll give you a small little example to illustrate it, and you can have a look at the longer question 5 then in your own time. So the share profit from associate here is 30, which is non-cash. And you're told the opening associate is 264, the closing associate is 276. We're not told anything about the acquisition of new associates during the year or disposals. So there's only 2 possible things that can move this line item. So you're trying to solve the puzzle. How can I explain how it went from here to here? The financial statements you're given are always correct. There's never going to be draft financial statements for a statement of cash flows. You're just going to have to do the statement of cash flows out. So you're saying, if this 264 was an opening debit balance, I'll increase that by 30, which gets me to 294. But my investment associate at the year end is only 276. So the difference between 294 and 276 is 18. That must have been the dividend that we received from the associate during the year. Because a share of profit, that is debit the investment in associate, credit P&L. That's the debit and credit for that. Whereas for the dividend, it is credit the investment associate, debit bank. And that is where your 18 comes from. You can do it columnar if you're comfortable with it, or you can do it in T account format. Either one is fine from the exam perspective. Right? So that investment associate dividend, that will be a cash inflow in investing activities. Just slot it in and you'll reference there you're working or where you're showing the exam and you're getting the figure from. So a lot of these statement of cash flow elements, they're smaller workings, but they all accumulate together for the exam question. So that's your first two complications, is NCI and associate. You then have kind of the third complication is either a mid-year acquisition of a sub or a mid-year disposal of a sub. And there's three things to consider now. And this is where you're moving on to questions, the more advanced level questions, but we'll do some basic examples to illustrate it in the lecture recording first. So if you acquire a subsidiary during the year, the first thing is, how much cash did you pay? Now you might pay shares as well, but that's not impacting the cash flow currently. And you're saying the net cash cost, the key word there being net, is the amount you paid less any cash you got on the subsidiary statement of financial position. Because remember, at the date of acquisition, that sub may have some cash, which you're now buying. So you net that off against the cash outflow of what you're paying to have the net impact on cash. And that will be a cash outflow in investing activities. Like we've seen with Glanbia in the previous recording. You see here acquisition of subsidiaries, purchase consideration. And what they've done then is they've showed a separate line item. Net cash acquired is 24. So actually the net of those would be 337 minus plus 24.8. That's what we mean by the net consideration. What you paid for it, less the cash you got on their balance sheet at the acquisition date. And that will be always given to you in the question. You then have to look at goodwill calculation, because if you acquired a subsidiary during the year, that may help explain the movement in goodwill from the opening to the closing goodwill. And you'll see that in a couple of the questions we'll go through. And also, and this is important where a lot of students make mistakes, if you acquire a subsidiary during the year, that means some of the movement between the opening group balance sheet and the closing group balance sheet is actually due to acquisition of a sub. So you need to strip out the impact of that acquisition when you're looking at the true movement of inventory, the true movement of payables, etc. during the year. Now that can be quite tricky when you're just talking about an abstract concepts like that. So we'll put it into practice now using a small example here, and also question 3 and then question 4 in your pack as well. It's important you grasp these concepts early on so you know what we're talking about. So here you're told P Limited, now this will be part of the bigger cash flow question, acquired 80% of the ordinary shares of S. And you're seeing there's goodwill of 24, and they paid for it by issuing shares and paying in cash. So what you're interested in, the first thing is, what was the net cash cost in terms of cash outflow for P? The cash outflow here was 400, but they got cash of 20 in. So if you're saying acquisition of subsidiary during the year, cash outflow, the outflow would be, as it says here, 380. Because you net them off together. What you don't put in here is the 200 is not a cash outflow. Because you're not paying cash, you're paying in shares. Where that 200 will go, and you'll see in the bigger questions, that will help explain the parent's movement in share capital. What you should see is share capital and share premium going up by 200. That'll help explain that. You should help explain the movement in goodwill. Goodwill should now be 24 higher, ignoring everything else. And all the movements in assets and liabilities. So when you go through each line item in the statement of financial position at the year end for the group, these elements will help explain the movements. They are not cash flow elements. They have to be explained separately. So that'll be important when we're looking at exam questions to understand exactly how does the subsidiary acquisition or disposal impact on the statement of cash flow adjustments. And what we're going to have a look at now before we move on is we're going to have a look at question 3, RATCO, just to give a very small abstract example before you move on to higher questions, because this is important. It's a fundamental difference than the normal individual statement of cash flows. All right, so we're looking at question 3, RATCO. So I want you to pause and have a look down through it and see, can you figure out what elements or what impact this will have in terms of the acquisition during the year. So you're told here, calculate the relevant amount insofar as the information permits for Ratco's consolidated statement of cash flows. And what you're told is you're given the extract of Ratco's consol into 2013, which is the start of 14, and into 14. And during the year ended 31st December 2014, Ratco acquired 100%. So that means there's no impact on the NCI. So this won't influence anything to do with the NCI for 240,000 in cash. And at the date of acquisition, the net assets included the following. That's what you bought at that date. All right. Now, sometimes you're given what goodwill is. In this case, you're going to have to calculate goodwill as well, because we're going to have to explain this line item. But the first thing you always do is, what's the net cash cost? So if you're answering question 3, one of the first items in Ratco's consolidated statement of cash flows will be cash outflow in investing activities of 200,000. 240 is what you paid, but you got 40,000 back in the subsidiary at the date of acquisition. So the net cash cost there is 200,000, and that would be in the investing activities. Just trying to take each element, slot them in as you go. The second thing to note is, well, if I acquired a subsidiary during the year, I paid 240 for 100%, and you got 100 plus 80 plus 40. Now be careful, that 60 is a liability minus 60. So that means there was here 240 cash you paid, you got 160, that means goodwill was 80. So let's put it up in Excel. So what you're saying here is consideration is 240, net assets at acquisition were 160. So your goodwill is 80. So again, you're not told this, you have to know to do this, because what we're trying to figure out, if you look in the question in Ratco, is how did Ratco's goodwill go from 20 to 100? Because we have to be able to explain that. And we can explain it perfectly, say, well, the only thing that happened in goodwill here, it went from 20 plus the 80 for the acquisition of Ardco gets me my 100. So there's actually no cash flow impact there. We're happy enough with goodwill. What you would be more concerned about, for example, if this goodwill was 80, we'll say that final figure there was 80 instead of 100. Well, that would mean there must be goodwill impairment of 20 at the year end. Because if you had 20 at the start of the year, you add on another 80 for acquisition during the year, debit goodwill, that means goodwill at the year end should be 100. If it's only 80, it means goodwill must have been impaired. And you know goodwill impairment is a non-cash adjustment. You have to add it back because it would have been in the P&L. So they can be quite tricky and quite hidden. And that's why you need to have your wits about you in terms of explaining each line item as you go along. So we've done the net cash cost. We've done the impact on goodwill, and we said there's no cash flow impact. What I want to look then is the last one is your working capital. So we look at the working capital adjustments here. Working capital adjustments, and we're going to do inventory, trade receivables, trade payables, and we'll do opening balance, closing balance. So inventory, 280 to 290, trade receivables, 340 to 400, and trade payables, 180 down to 150. Now, again, if you've gone through question 1 and 2 and you've revised your basic IA7, we know movements in working capital impact cash flow. So when we're doing our indirect method, we need to know the movement. So the movement here is a 10, an increase. There's an increase here of 60, and there's a decrease here of 30. And usually that's what we would do in terms of bringing those adjustments in then, saying whether this is good or bad for cash flow, and putting it into our working for cash flow from operating activities. The problem is here, if you go back, the opening balances here for all these items exclude Ardco, because Ardco was only acquired during the year. So these opening balances exclude Ardco, whereas the closing balances include Ardco. Because again, you've acquired Ardco during the year, that means the consolidated statement of financial position at the year end, like we know for goodwill, it includes the 80 from our acquisition during the year. So it helps explain the movement and figure out if there's any impact in the cash flow statement. So that means if we're looking for the true movement in trade receivables, the true movement in inventories and trade payables, you need to remove the impact of the subsidiary, the acquisition subsidiary. So what you're saying here is inventory increased overall by 10 during the year, but the sub-acquisition actually attributed 100 to that. So the true movement, if you're comparing like for like, i.e. if you exclude Ardco from both, the true movement there is actually a decrease of 90. And that's the figure that should go in the group cash flow. Because the acquisition of these subsidiaries, they are already dealt with through the cash flow impact of the 240 less the 40. So you don't leave them in twice, you'll be double counting it. So that's conceptually quite difficult. Is what you're saying is we want to compare like for like. So we need to exclude Ardco from both. If we excluded Ardco, this balance would actually be 290 minus 100 to take it out. So it would be 280 compared to 190, which is a decrease of 90. And that's where it's coming from. So you can do it in multiple ways. We're just trying to show you, you need to adjust the subsidiary at every point. And that's what this slide is talking about here. Net cash cost, the goodwill, but also impact on any other statement of financial position line item. Particularly here, your working capital. You do the same for trade receivables. Trade receivables and acquisition, you took on 80. So actually, an increase of 60 was all explained and more by the sub. That's a 20 decrease. And the last one then is the trade payables. You took on 60. So although your trade payables overall have decreased by 60, if you took out the subsidiary, they decrease even more. There's a 90 decrease. So these are the ones that will go in then. And remember, a decrease doesn't mean negative for cash flow. What you're saying, decrease here in inventory, that would be positive for cash flow. So you'll be adding on 90 when you're reconciling between profit and cash flow. Remember that from your undergrad days. A decrease in trade receivables the same, but a decrease in trade payables is the opposite. In both of these cases, there's less money tied up in assets, so that means it's coming into cash flow. In this case, there's less money owed to suppliers, which means you must have paid them, which is a drain in cash flow. Right, so that's quite a tricky thing to do conceptually because it's brand new to you. But when you have an acquisition of a sub, you must adjust each line item to take account of the extra that's coming in because this was an acquisition during the year. Right, so that was just looking at a small example, question 3. But again, see when you layer in mid-year acquisition disposal, and for example, if we only acquired 80% there, then you'd have to value the NCI at the date of acquisition and use that to explain the opening and closing NCI that you would see in the statement of financial position as well. So there's a lot of moving parts, but we're trying to build on question 1 to question 2, all the way up to question 7, 8, and 9, which are exam level questions. You do a similar logic then when you're looking at a disposal of a subsidiary. You now look at the net cash proceeds, which is how much did you get in cash, less any cash that you left in the sub at the date of acquisition or date of disposal. So it's the opposite of before. You then look at the removal of goodwill and see does that help explain any item in the goodwill line item. But also remember you'll now have gain or loss on disposal. So that's one way disposals and cash flows can be asked together is when you sell a subsidiary, you have to calculate a profit or loss on disposal. So that will be in the consolidated P&L. But remember, it's non-cash because the cash element is in number 1 above. And you then have to look at the other line items. That if you sell a sub during the year, it takes out some of its inventory. It takes out some of its trade payables, its NCI. And you need to use that to help explain between the opening and closing balances in the completed statement of financial position. So quite a lot of moving parts, but quite similar to the mid-year acquisition of a subsidiary as well. Let's take a small one to start with. You're told here, during the period, P sold all of its holding in the subsidiary for 140,000 in cash. And this was the SOFP at the date of disposal. Well, the first thing is, what's the net cash proceeds? Well, your net cash proceeds here, if you look at it, you're getting 140 in, but you're giving away 14 on the balance sheet of the subsidiary. So the net cash inflow in investing activities would be 126. 140 less your 14. And that will go straight in as an item in your statement of cash flows. The other thing to remember, and you don't have this when you acquire a subsidiary, because you're calculating goodwill, but here we're actually going to make a profit or loss on disposal. We're selling something that's in there at 160, but we're selling it for 140. So in my statement of profit and loss, because you're assuming everything is accounted for correctly in a cash flow, you're just given the finished financial statements, there is a 20 of a non-cash adjustment. So that would be the loss of a subsidiary, the loss of disposal of a subsidiary, but that's not cash. The cash is the 126. So when you are doing the indirect method, you have to add back that, like you would add back the loss and disposal of PPE, or like you would add back depreciation. Right? So it's important to understand those little bits. And what we're going to do now is we're just going to consolidate that knowledge by looking at question 4. RATCO again, but this example, you're now selling a subsidiary rather than buying one. So have a look at that and see, can you make a stab at it, similar to what we've done for question 3. So in this question now, RATCO have disposed of ARDCO for 300,000 and sold it all. So there's no impact in terms of NCI, which we'll get onto in the more advanced questions. So the first obvious one we'll always do is, what's the net cash proceeds? Well, you sold it for 300 grand in cash, and the balance sheet of the subsidiary that you sold had 40. So the net cash proceeds, which would be a positive cash flow in investing activities, would be 260. And that's all you have to put in. That's the net cash impact. Right? So your first thing always is net cash cost for acquisition of subsidiary, net cash proceeds for the disposal of subsidiary. The next thing then is, what about goodwill? Well, we know goodwill at the date of disposal is 50, but we can see here goodwill has gone from 100 down to 20. Well, we know 50 of that can be explained because you will credit goodwill. This 2013 includes ARDCO, because ARDCO was a subsidiary at the start of the year. This 2014, end of 2014 figure excludes ARDCO because you've removed it at the date of disposal. We don't need to know what the date is. We just know it's before the year end. So that means for goodwill, 100 minus 50 means goodwill at the end of the year should have been 50. If goodwill is now only 20, that means there must have been a goodwill impairment of the other, what's left in the goodwill. So that's important. You can do it as a T account, or you can do it in columnar. Opening balance was 100. You have the disposal, which you take off 50. You have the closing balance, which you take off 20, which leaves you with a net movement there of 30, and that's a hidden impairment. So there must have been a debit the P&L, credit goodwill 30 during the year to make it balance. You can do it in T account format as well, but we now know that impairment is a non-cash adjustment. So when you're going to do your net cash flow from operating activities, like the way you add back depreciation, you will add back goodwill impairment as well. So it's kind of hidden that you have to do that working first before you finish off your cash flow from operating activities. So that's the second thing you will always have in disposal is, what is the impact on goodwill? And is there any goodwill impairment? And the last one we're going to set up as we've done before, trade receivables, inventory and trade payables, which are your working capital adjustments. So just copy this down just to show you, just to illustrate the key points. And we'll get rid of these. So in this case here, opening inventory, 300, 230. Trade receivables, 400, 340. And trade payables, which is 190, 110. So that's a 70 decrease. That is a 60 decrease. And that is a 90 decrease. So that's where you always start off. What's the high level movements? Right? And if that was an individual statement of cash flows, you'd slot them in, whether it's a positive or negative impact on cash flow. But when we go to consolidated statement of cash flows, you have to remember here, this includes ARDCO. Because ARDCO was sold during the year, so it must have been there at the start of the year. This excludes ARDCO because you sold it during the year. So what's important that you need to understand is, this is not a like-for-like comparison. you're not looking at the true movement in inventory because actually you made a sub disposal. And when you disposed of it, you got rid of inventory for 100, which had nothing to do with cash flow. It was to do with the sale of a subsidiary. And that sale of the subsidiary has already gone in. The net cash adjustment you've already put in there at 260. So you don't double count it. That's why we have to exclude this. So sub disposal of 100. So actually the true movement here is a 30 increase. Because the underlying business has increased by 30 and the subsidiary has gotten rid of 100. So if you excluded Ardco from both, you take 100 out of here, which leaves you with 200, and there's your net increase of 30. So it's important conceptually that you understand that, because you'll see it in every single consolidated cash flow question. You have to exclude the impact of the subsidiary to get the true movement in working capital of the underlying business. For the trade receivables, you acquired 80. So that's actually an increase of 20 when you strip it out. And the trade payables went down by 60. So of that 90 decrease, 60 is attributable to the sub. 30 decrease must be attributable to the underlying group, excluding the sub. And they are the main adjustments that you will put through your working one, the net cash flow from operating activities. An increase in inventory and an increase in trade receivables are negative for cash flow. So you'll take off the 30 and you will take off the 20 for trade receivable movement. A decrease in trade payables is also negative. So trade payables and trade receivables, the opposite in terms of cash flow impact. So all of those you will be taking away if you were doing a larger statement of cash flow question. Now that is an important concept that you understand in question 3 and question 4 and why you're making those adjustments. This sub-disposal working capital items have already been accounted for in the sub-disposal. So you need to strip them out when you're looking at the movement of working capital. You need to make sure you're looking at both on a like-for-like basis. And currently that's not fair because the opening balance includes the sub, the closing balance doesn't. And that's how we do it there. There's a number of ways you can present that, but the key point is you get these correct answers that you bring forward. Right, so that's an important one to go back and have a look at question 3 and 4. And when you're happy with that, then go on and have a look at question 5, which brings in an acquisition, but you now have an NCI, and you also have an investment in associate. That's a bit trickier of a one. And once you have question 5 done, then question 6 is an online recording for Splash, and questions 7, 8, and 9 are more exam level questions. So there's plenty of practice questions there once you go through the basics. Right. I also give you a couple of steps, just suggested steps of how you might go through it. But again, that's personal preference. The more questions you go through, you'll hone your exam technique of how you'll approach these questions. Right. So again, focus on the basics in terms of your key steps here. Be able to do an individual statement of cash flows. Know the key headings, know how to approach it, and then practice using T accounts, particularly for the harder items. And see the consolidated statement of cash flows as a puzzle. You know what you're working towards, you know the end solution, and you know all the items that are trying to help you to solve that puzzle. So it's just about practice. The more questions you practice here, the more similarities you will spot in each of the consolidated questions. Right, so IA7 does require certain disclosures. Again, you don't need to worry too much about them. One of the main disclosures, and you will lose marks if you don't show it, is this bottom element. That you must show a reconciliation between opening and closing cash and cash equivalents. And your answer should explain the movement. That's a key requirement under IA7, and you will lose marks if you don't provide that in your statement of cash flows as well. And then there's other IA7 disclosures which are required, but again, you don't need to worry too much about those in the broader scheme of things for here. But you certainly need to be able to prepare a statement of cash flows. So have a look at question 8. We've done question 3 and 4, basic ones. You have to look at question 5 now, and question 6 and question 9, more exam level questions, are also available as online recordings. In next week's session then we'll start to look at the last topic around IFRS 12, which is consolidated disclosures, and IAS 24, which is related party transactions and related party disclosures.